markets at their peak, but your wallet is shrinking. This paradox isn't random, and it's causing millions to lose money without knowing why. Stay until the end. You'll get 3 steps to protect small capital actionable tonight. No big capital needed, no predicting the future, just 3 right decisions in 16 minutes. Here's the reality. Rising indices don't mean you're getting richer. It only means a few are getting richer. And if you're not in that group, if you see house prices rising, gold prices rising, but your salary stays the same, you're standing outside the game. That's why this video matters. Not to make you more afraid, but to give you a map. I understand the helplessness of watching opportunities slip away. 7 years analyzing macro, I've seen this scenario 3 times. And each time, those with a plan survived. Those without lost 30-50% of their capital. You don't need to catch everything. You just need to protect what you have and put it in the right place. The 3 steps I'm about to share aren't complicated. Step 1, check your safety margin. Step 2, the averaging rule. Step 3, the 3-question filter before every order. Sounds simple? It is, but 90% of people ignore it. To understand this paradox, you need to know one truth. Right now, there aren't one, but 2 economies existing in parallel. The first economy, Wall Street, financial markets, where printed money flows first, indices hitting peaks, assets rising in price. The second economy, Main Street, real life, where you and I live, wages rising slowly, living costs escalating, savings shrinking. Visualize this on screen, 2 parallel worlds, increasingly separated. And between these 2 economies, there are 4 disconnection mechanisms. I'll unlock each one. Mechanism 1, unequal liquidity in 2 minutes. Mechanism 2, concentrated profits in 7 minutes. Mechanism 3, financialization in these minutes. Mechanism 4, the expectations game in 11 minutes. But before we dive in, there's something more important. Calm down first. Train to seconds. First practice, escape FOMO. When you feel anxious, panicked by the news, do this. Breathe in. 1, 2, 3, 4. Hold. 1, 2, 3, 4. Breathe out. 1, 2, 3, 4. Hold. 1, 2, 3, 4. One more time. Together. Breathe in. 1, 2, 3, 4. Hold. 1, 2, 3, 4. Breathe out. 1, 2, 3, 4. Hold. 1, 2, 3, 4. And remember this, I don't control the market. I control my next 15-minute decision. Say it silently 3 times, right now. Good. Now we're ready. You know what? There's a massive flow of money being pumped into the system. The Fed prints money, governments ease up. But why do the zeros in your account stay the same? Here's the real reason. Money doesn't flow evenly. It reaches this place first, that place later, and some places it never reaches. If you're standing in the wrong position, you just watch others get richer. And yourself? Still the same. Here's the mechanism. When central banks print money, it doesn't fly straight into your pocket. It flows in order. Step 1, money reaches big banks. Step 2, flows to financial markets, stocks, bonds, real estate. Step 3, then to businesses. Step 4, finally, reaches your salary. If you're lucky. House prices rise first. Gold prices rise first. Stock indices peak. But salaries rise 1, 2 years later, or don't rise at all. Visualize this on screen, a funnel. Money flows from top to bottom. Those at the top catch plenty. Those in the middle catch little. Those at the very bottom only get the last drops. So what do you do about this? 3 simple things. 1. Don't chase soft landing news. When the news sounds good, prices already went up. You're late. 2. With small capital, prioritize understanding money flow before investing. Ask yourself, which assets does money touch first? That's where you need to pay attention before it spreads to salaries. 3. Keep some cash, 10 to 20%, ready for when everyone panics. That simple, no need to complicate it. And this leads us to the biggest mistake. The biggest mistake? Reading headlines and making decisions immediately. Soft landing confirmed. You buy. Interest rates dropping sooner than expected. You go all in. Market hits new peak. You add more. But when you do that, you're not investing. You're reacting. And emotional reactions, that's the fastest way to lose money. Let me tell you a story. December 2023. Headline: Fed pivots. Interest rates will drop in 2024. Mr. A reads it, thinks, markets will rise. He goes all in. Tech stocks, Bitcoin, everything. January arrives. Interest rates don't drop. Inflation still high. Markets go sideways. Mr. A, stuck. The problem isn't the headline. The problem is he believed before verifying. Headlines aren't for you. They're for algorithms, for clicks, for emotions. When you read soft landing, prices already went up. Smart money entered 3 months ago. And you? Late arrival, buying at the top. So what do? Simple. The 3-question filter. Before clicking buy, ask yourself. Question 1. Is this source reliable or just clickbait? Question 2. Where is this information in the cycle? Just emerging or already repeated 10 times? Question 3. How does it affect my cash flow? Specifically, not generally. These 3 questions takes 30 seconds, but saves capital. You don't need to trust me. Just try it, and I'll show you how to use it right now. Right now. Try it with me. Headline: Stocks will rise 30% this year. Question 1. Is this source reliable? Ask yourself, who wrote it? Which site? Do they have a track record? Question 2. Where in the cycle? Is this news brand new, or has it been repeated all month? Question 3. How does it affect my cash flow? If it's right, what do I do? If it's wrong, how much do I lose? 3 questions, 20 seconds, done. But this is just the beginning. You hear the news, S&P 500 up 15% this year. You think, wow, economy's doing well. Everyone's wallets are full. But wait, what if I told you that 80% of that gain comes from just 10 stocks, and the other 90 stocks? Flat or down? This is the biggest trap. High indices don't mean everything's good. Here's how it works. Stock indices, they're averages, but not equal averages. Big stocks, banks, tech, energy have high weightings. When they rise, indices soar. And small stocks, even if 50 stocks drop, indices stay green. Why? Because their weighting is too small. Imagine this. A class of 100 students. 10 rich kids score 9 to 10. The other 90 score 3 to 4. Class average? 6.5. Sounds okay. But the truth? 90% of the class is failing. Markets are the same. Rising indices don't mean your stocks are rising. Don't mean the economy's doing well. It only means a few are pulling the whole basket. So what do? 1. Don't buy because indices are rising. Ask, does this specific stock have its own reason to rise? 2. Check which stocks you're holding. Top 10 or outside the basket? 3. If your basket doesn't rise when indices rise, don't blame yourself. That's normal. But don't sit still. Adjust. Or accept. And this leads us to the next mistake, a mistake that even knowing this, you still make. This mistake, more psychological. You see the news. Economy growing at 6%. Then you look at your wallet, look at gas prices, look at electric bills, look at rent. You think, they say the economy's good, but why do I still struggle? And from there, you start doubting yourself, doubting your decisions. But the problem isn't you. The problem is, you're comparing wrong. 6% growth is an average number for the whole economy. But you don't live in average. Some people's salaries rise 20%. Some lose jobs. Some buy houses easily. Some rent forever. When you compare your feelings with the whole country's numbers, you'll always see discrepancy. For example, the average per capita income in the US in 2024 is around $65,000. But in places like San Francisco or New York City, it can exceed $100,000. Meanwhile, in many rural counties across the Midwest or South, it's often below $40,000. Where are you in that number? Remember the 3-question filter earlier? Apply it here. Question 3. How does it affect my cash flow? Not average cash flow. If you're living in a rural area and you hear $65,000 as the national average, then look at your own income. Say it's $38,000 and wonder, am I falling behind? You'll feel like you're losing. But in reality, you're exactly within the range of your region. You're comparing your life to the wrong benchmark. The problem is you're using other people's standards to measure your own life. So how do you fix this? 3 self-check points. 1. My income. Up or down compared to last year, not compared to average. 2. My living costs. Specifically, rent, food, gas, electricity. Up by what percent? 3. Asset allocation. What percent do I keep for emergencies? For investment? For spending? These 3 questions. Compare with yourself, not with anyone else. And now, we reset. 30 seconds. Breathe with me. Breathe in. 2, 3, 4. Hold. 2. Breathe out. 2, 3, 4, 5, 6. One more time. Breathe in. 2, 3, 4. Breathe out. 2, 3, 4, 5, 6. Good. Now, you're ready. 3 steps. Simple. Protect small capital. Step 1. Safety margin. Step 2. Averaging rule. Step 3. Filter before every order. Let's go through each step. Step 1. Personal safety margin. Calculate your monthly expenses. Rent, food, transportation, bills. Add them up. Multiply by 3. That's minimum. Multiply by 6. Better. That amount, put it in 3 safe places. 50% cash at home. ATMs can run out during crises. 30% flexible savings account. Withdrawable within 1 day. 20% fixed term savings. 3 months. Slightly higher interest. Don't put 100% in one place. Diversify risk. Don't touch it, unless it's an emergency. This is your fortress. Step 2. Averaging rule. Choose a fixed amount. Every month. For example, $1,000. Buy on the same day. Same asset. Don't care about price. Market high. Buy. Low. Still buy. Consistently. This is called dollar cost averaging. No FOMO. No panic. Just discipline. Pause the video right here. Screenshot this. Or hit save. This checklist is worth more than Miss Mia's $8,000. You'll meet her in 2 minutes. Step 3. Filter before every order. Before clicking buy. 3 questions. 1. Is the source reliable? 2. Where in the cycle? 3. How does it affect my cash flow? 3 questions. Trent seconds. Before every decision. That's all. Save this checklist. You'll need it. Sounds simple. But what about reality? Let me show you an example. Real person. Real numbers. Miss Mia, 28 years old. marketing specialist in Dallas. Starting capital, $8,000. Goal, save for a home down payment in 3 years. Last month, she saw the headline, "Stocks are on fire." She panicked, put all her money in. Next week, the market dropped 15%. She came to us. We applied the 3-step plan over 2 weeks. Here's what happened. Week 1, Step 1, safety margin. Miss Mia calculated her essential expenses. Due dollary, month, 3 months equals $6,000. But she only had $8,000 total. Decision, she kept the full $8,000 in a high-yield savings account. No more investing for now. Her new goal, save $2,000 more before re-entering the market. Week 2, Step 2, dollar cost averaging. She committed to investing $300 month into index funds. Same day each month. No more guessing the market. Step 3, the 3-question filter before any trade. 1. Is the source reliable? 2. Where are we in the cycle? 3. Will this affect my actual cash flow? This time, she didn't buy. After 2 weeks, she still had $8,000. It didn't grow, but she didn't lose another $1,200 like last time either. And for the first time in 6 months, she slept through the night. No more obsessively checking apps, just a calm plan with clear steps and peace of mind. You can do the same. No need to rush, no need to be perfect. Start with step 1, 1 week. Just calculate safety margin. Next week, add step 2, slowly, but surely. And now, the final question. The final question isn't how. You already know how. The question I asked myself 2 years ago, and now ask you, when will you start? In these 17 minutes, you've understood why markets are high but wallets are low, recognized the 2 biggest mistakes, reacting to headlines and comparing with wrong standards, got the 3-step checklist, saw a real case, and most importantly, you breathed, you calmed down. Now there's only one thing left. Start. Here's what I want you to do. 1. Save this video. Hit the save button. Checklist at 11 minutes 50 seconds. You'll need it. 2. Try 7 days. Just 1 step. Start with safety margin. Next week, add step 2. 3. Comment 1 sentence. Your chosen mantra today. I don't control the market, I control my next 15-minute decision. Or your own phrase. Leave it below. That's all. And one more thing. Next video, I'll show you 3 warning signals that a crisis is coming and how to protect 100% of capital in 48 hours. No need to guess, just recognize. The first 2 signals, 90% of people miss them. Signal number 4, only 7 days to act. Signal number 3 will surprise you. It will appear in the corner of the screen right now. Click to preview. Remember, markets will rise, will fall, will go sideways. But you'll stay calm. You'll have a plan. You'll have your safety margin. You'll buy consistently. You'll filter before deciding. And most importantly, you'll be able to sleep, just like Miss Mia. See you again.